Let's be honest, if you're a finance student, you've probably heard the terms futures and forwards tossed around in class, textbooks, and maybe even on the news. But what actually sets them apart? Why does it matter if you're trading a future or negotiating a forward? Let's break it down so you can ace your next exam, or just impress your friends at the next finance club meeting. Both futures and forwards are types of derivative contracts. That means their value comes from something else, like gold, oil, stocks, or even an index. At their core, both are basically agreements. I'll buy from you, you'll sell to me at this price on that date. But here's where the similarities end, and the differences start to shape the real world of trading. First up, futures. Imagine a future contract as the ultimate standardized agreement. Everything's fixed: quantity, quality, and the delivery date. Why? Because futures are traded on big regulated exchanges, places like the CME Group or ICE. This standardization makes futures super liquid. You can easily get in and out of a trade just like you'd buy or sell a stock. Now here's what's cool. Every futures contract goes through a clearinghouse. Think of it like a referee that guarantees everyone plays fair. If one party can't pay up, the clearinghouse steps in, so there's almost no counterparty risk. Plus, futures are marked to market every single day. That means your profits or losses are settled daily, not just at the end. If your trade starts losing, you might get a margin call. Basically a hey, put more money in or you're out. And yes, you do need to put down some cash up front called margin. This gives you leverage so small price changes can lead to big gains or losses. Because these contracts are standardized and traded publicly, futures markets are transparent, liquid, and tightly regulated. You know the rules and you know the risks. So, what about forwards? Forwards are like the handshake deals of the finance world. Totally customizable and negotiated privately between two parties. No exchanges, no clearinghouse. Want to lock in the price for a weird amount of coffee beans with delivery in 7 months? You can do that. The downside? More flexibility means less liquidity and a lot more counterparty risk. If the other side bails, there's no referee to back you up. Forwards aren't marked to market daily. They settle at the end, all at once. There's usually no margin, and unless you both agree, you can't just exit whenever you want. These deals are private, so there's less price transparency and almost no regulation. In short, futures are the fast, standardized, safe way to speculate or hedge in busy markets. Forwards are the flexible, customizable tool for businesses handling unique, off-the-wall needs, but with more risk. Remember, understanding the difference could make or break your strategy, whether you're hedging million-dollar risks or just trying to pass your next finance quiz. If you found this breakdown helpful, hit that subscribe button for more no-nonsense finance explanations. I'll see you in the next one.